Alrighty, let's go ahead and get started. Welcome everyone to the Hub Live Trading Room. Great to be back with you all during this trading day and during trading hours. First and foremost, as always, we do have to cover our disclosure disclaimer agreement. The main thing to take away from this is that we are not licensed investment advisors in the United States, so nothing's to be taken as personal investment advice. This is always available on our website to be read in full detail at your leisure, or feel free to take a screenshot of it now if you like, but that's the main point to take away. Other than that, without any major news catalyst to move the markets today, it seems like it might be a good time for some consolidation, and that's pending the rest of the market hours. We don't receive any major news events. So at this point, I'd like to remind everyone to register for the Hub AI Launch Code event. That's going to be taking place next Tuesday at 8 p.m. So that's July 1st at 8 p.m. We encourage everyone to register as it's going to be a very insightful session. I'm going to go ahead and drop the link to register in the chat, and please look out for it in the description for the video as well. Interested to see how everything plays out. Of course, very excited to interact with you all. So without further ado, let's get right into it. Rob, you out there?
I am Zach. Hey, everybody. Welcome to Hub Trader Live in this market day here midweek on Wednesday. And as you mentioned, Zach, really for the first time in several days, there hasn't been any sort of a major news catalyst type event to move the markets. And as I've talked about numerous times, I just want to remind you that those news events move things on the short term, but they tend not to have long-term effects. So we've seen that intraday volatility play out quite a bit over the last few days. Maybe we are due for just a more quiet day today. You can see that we are really in a very low volatility intraday scenario here at this point in time. I mentioned yesterday during Trade Finder that I hated the fact that we had the big gap up yesterday. I wish we would have just followed through what happened on Monday with just a nice steady climb up, because we have to contend with that gap. Now we're so close to where all these C wave zigzags said we were going to go, which is back to the previous wave 5 high. Hopefully all of you watch the US market update that I do every weekend, and you saw those macro charts that are provided by the same guys that provide the AI signals here, which is what we're here to talk about during the Hub Live trading room. And believe it or not, the macros are on the, I can't say bullish because they don't go bullish or bearish, but what they show is how the economy is performing, contraction, expansion, what's going on with liquidity. They follow the Fed liquidity. They follow the global M2, which is money supply. If you're not familiar, M2 is checking accounts, savings accounts, CDs, money markets. Pretty much anything that's liquid is included in the M2 money supply. So not only do they look at what the Fed is doing, which quietly behind the scenes, even though Chairman Powell has taken a lot of heat from President Trump, they are quietly injecting liquidity. At least that's what the statistics show. And they have numerous weapons in their arsenal. Kind of maybe a bad time for a pun like that with the war stuff that's going on. But they do have numerous ways that they can ease tension, ease contraction of money supply, and actually expand money supply other than just simply cutting rates. I do think that President Trump will talk more about this tomorrow night in the insiders meeting, I'm sure, with Jeff, but he makes a point. Go ahead and cut rates now, and if inflation comes back, hike rates then. What do you got to lose? Take a shot now. And if he's wrong, and Chairman Powell is concerned about inflation being imported through tariffs, and the tariff pause ends on July 9th, so we're going to watch that date. So, I feel like that's a valid point, but the name calling, I don't think, is going to help Chairman Powell or the Fed get off the schneid, as Chris Berman of ESPN would say. But Chairman Powell is facing not only criticism from President Trump, but now he's getting some of his FOMC voting members that are breaking ranks. 3 of them in the past few days have said they would actually vote in favor of a rate cut in July. I don't think that's going to be the majority. I don't think we're going to have a rate cut in July. But with that growing swell of support for rate cuts, perhaps September is definitely in the cards. Um, we'll have to wait and see. But let's get to the look at the market now, and then we'll start looking at the AI signals, which again is why you're here. Didn't have that gap up yesterday. We're consolidating today. The only question in my mind, we're so close to those February highs and all of these zigzags. The primary one that started way back in the tariff tantrum lows. Zach, you made a great job of coining that term. They had a really nice run in that big zigzag, complete with not only two zigzags to make the C wave double complex, if you will. I don't even think that's an LA wave term. I just coined that. But then we had a triangle in the last zigzag. So the third zigzag was complex as well. So it's been a complex market. It definitely has, with lots of ebbs and flows. So moving up and down, choppiness, if you will, but still grinding higher. Grinding higher is not necessarily what we want as option traders. That makes our job a bit more difficult because of the time it takes and the implied volatility swings. But nonetheless, that's the market that we have. And again, the only question in my mind, the point I was originally trying to make is, do we hit those February highs first, or do we need to come down and fill this gap first? I would like to see the markets go up, hit that level, realize the fact that we are at the February highs, maybe even tick a little higher so that all the news headlines are the markets are at a new high. That is when we would be ripe for some sort of a corrective move, maybe enough to come back down and fill that gap. We almost perfectly tested the point of this triangle breakout, so you can kind of say that that was completed. But we're still going to have to fill this gap at some point in time. And if we follow zigzag rules, we need to retrace one of these C waves. So that means at some point in time we could see 575 again, but that could be well into the future. Maybe more towards September. Maybe it's a buy the rumor, sell the news on the rate cut. If we get the rate cut in September and then the market sells off, that would make sense, but that's still a couple months away, and who knows where we could be in the markets from there. But this quiet day today is, pardon the pun again, exactly what the doctor ordered. We need this sideways stuff because we're a little bit away from the 10-day moving average. So a little bit of a tick down today at this point in time. We're down 6 points on the E-mini futures. Not a big deal at all. There is a possibility that we could have run up and hit that level, which is what I want to talk about. So let's start talking about AI. And we do have the alert on AR, which is not only in the AI Impulse portfolio, but it's in the Top Shot portfolio as well. And this is what I wanted to discuss in today's session. How do we handle when we get these AI signals? I've been talking about this a little bit, but I wanted to talk about it a little bit further today, that when you see these signals, sometimes we get the big run up. And I think what you have to weigh out here, well, I'm going to give you three alternatives of what to do, kind of like what we talk about with the B wave contraction on a zigzag pattern. If it only goes to 38.2 and bounces, do you jump in on that? Do you wait for 50%? Do you wait for 61.8%? What do you do? And we've talked about a third, a third, a third. If you wanted to come in on a bounce off the 38.2% level. Something similar to that is one of the alternatives that I'm going to give you on these AI signals. So we get the signal and we have a nice sideways day, then we run up. I think one of the things that we can put in that I've noticed, I'm still learning with the AI signals just like you guys are, because even though I've been trading for a long time, this AI stuff is relatively new. We started back in 2020 with the AIification of the time strategy, but the impulse strategy is basically a year old. So a year in the world of trading is nothing. You still have a lot to learn at that point in time. So what do we do? Do we jump in and just assume that we're going to make a direct run? Because we've seen that enough times that the AI signal comes out, and even if we're a little bit overbought from the 10-day moving average, we directly run to the target. And I've missed a couple because we were a bit overbought when the signal came out. But I've also had scenarios, as you all well know, that we jump in and then we get this pullback move. And then we come back down, and at least at this point, AI is at, or AR, excuse me, AI, Freudian slip, is testing this A wave extension very well. And if we hold here and turn and go back to the upside, that would be very classic technical action on this signal, even though it doesn't feel well that we were in a gain and now have given that back on this corrective move to the downside. So if you look back in hindsight, Monday morning quarterbacking, it's a comment that the Aussies like to hear me say. You could say, well, we were overbought, we should have waited and then gotten in. But then again, you've seen those that we've missed because they ran straight to the target, and there is no answer. I've talked to the data scientists, and there is no solution to what is the best scenario. So what we have to do is figure out what's the best scenario for ourselves. And one of the things that we can do is we just get in, and if there's a pullback, we understand, we exercise patience, we wait. We've seen so many times where we've had pretty decent drawdowns in the alert that eventually turned, went and hit their AI targets, and ended up being profitable in the alert. But it never is fun to see a little bit of green go away and even maybe turn a little bit red. So if you decide to wait, you miss those ones that run straight up, again, which I have done as well. And if you come in early, then you have to deal with if it does retrace a little bit, because there's no doubt that the AI catches the momentum run. The AI is designed to catch the first day to level three, or the wave three, if you will, segment three, as Ralph Nelson Elliott would have put it, is labeled. And so that's likely been a strong move day. It's broken resistance, and the free has been labeled. And sometimes it continues, sometimes it doesn't. So the alternatives that I wanted to give you are: one, you wait, and then you look and see if there's a pullback. And if you're more conservative, this might be the better way to go. If you can't handle drawdowns and alerts, if they really bother you to see those in your account, then you wait. And then you know that you're going to risk missing the ones that just run straight to their target after the alert is sent out from the AI program. And if you get in, then you have to realize, well, we may get a pullback here. That's okay. I trust the AI. The accuracy has been even above what the AI guys thought it would be. I think we're at like 82% or something. And you know that we look for entries when this AI signal is at 75. I've even tagged that down to 70, which is why we have the alert on AR. And I like the amount of room here. That could be a signal to take a look at too. So when the AI signal comes out, if the target is not very far away, that could be an indication this is one that's going to run straight to the target. If there is a little more room of movement, maybe that tells you that we might get a pullback before we turn and run to hit the target. So that's something to weigh out as well. So you have the two choices so far are just get in and know that it may run up. We've had plenty of alerts that were profitable in 1 to 3 days, and then we have some that have taken time. And you exercise the patience, or you be more conservative and you wait to see if you get a move back down towards the 10-day moving average, which is exactly the case in AR. And then you wait for those, understanding again, you'll miss the ones that run straight up. Maybe that's okay with you. Again, you have to look inside yourself with your own risk tolerances and make the decisions that are the best for you in your own portfolio. Or the third choice is very similar to what I just talked about with the zigzags, where you get a B wave correction to 38.2 and it bounces. In that case, we know that that could hold and we could run up to a 61.8% extension. Or We could get a bounce off that fib level because remember, fib levels act as support and resistance. Not unusual to see a bounce off the 38.2% level, but we don't know for sure that's going to hold until we actually hit the 61.8% level. So, one of the things that I've given out on zigzags is maybe you just come in with a third of whatever amount you're willing to put at risk in any one alert. And we're all different there. We all have different size accounts. You know that we put $500 of risk in an alert at Evo Trader, but you have your own size account and you're accordingly using your own risk management on the size of the position that you put in. So maybe you put half a position in. So I'm not going to do the third like I talked about with the zigzags where you put a third if it bounces off the 38.2% level. If it comes down to 50%, you add another third. And if it bounces off that, but then comes back down to 61.8, you add the final third. Now you have a full position and you're at that very strong 61.8% level. But if you wait for a 50 or 61.8% B wave correction, you're missing those that do bounce from 38.2 and run up to the 61.8% extension. It happens often enough that it's part of the rules that we follow. But in this case, my suggestion is if it does bother you when there is a bit of a pullback after these AI signals are sent out, put half a position on at that time. And if it runs and hits the target, at least you're involved and you make a profit in the trade. Maybe not as much as you would have liked, but a profit's a profit, and we're moving forward. Or put half the position on and wait. And if it does pull back down to a level like AR is now, now I don't know if it's going to hold this level at the A wave, but it's a very logical place for this to hold because you can see going back, it was resistance in January, in February, in March, and again in May. And then we broke it with the move that initiated the AI signal. That was the move that broke it. That was the uh, implied volatility injection impulse move, the momentum move that the AI captured. And so we're coming back down to test that level. This is really classic, right? You all know this. What was resistance can now become support, and it needs to be tested. Is it going to act as support now? Is this indeed a break to the upside, as the AI suggests at 72%? There's a 72% chance that that's what's going on, and that we're going to hold here and then turn and run back to the upside. We know that we've had big runs in gold, silver, energy, etc. So a little bit of a pullback is warranted there. So my suggestion to you is if it does bother you, and I know some of you have more patience than others, that's the one word that I try to emphasize as much as possible to be successful in trading is patience. As you also know, I'm not a believer in having some sort of an X% on a move down in a position to automatically exit. I think that is death by a thousand cuts. That's been my experience over a very long time, and that's why you're here is to learn from my experience. Not trying to say that I'm the world's greatest trader. I don't say that at all. And the market is very humbling. It still humbles me at times as well, but I have a lot of experience to share, and patience is the main thing that I've learned. Right about the time when you're at, there's two different theories on max pain. One is with options. Where is the level? What strike price has the greatest open interest on the call and the put side? In other words, if we close there at expiration, where will the greatest amount of options expire worthless? That's one definition of max pain. A psychological definition of max pain is when you get to the point where you're ready to give up, you're ready to throw in the towel. I've had enough. I can't take this anymore. That's the time to get more aggressive because once you get to that, just from a purely psychological standpoint, that's when things are getting ready to change. And in the case of an individual trade, that's likely when it's getting ready to reverse and go the other way. So that's an alternative for you. Put half a position on the initial alert, and if it does pull back, then add the other half on. So just wanted to share that with you. Another example, and we have not sent out an alert on this one yet. I did this on purpose because I wanted to share this with you, is on CNX, and it's the same scenario here. You can see where the alert date was sent out. Then we had a doji, so there was indecision. We started to move to the upside. And if you waited, you're thinking, dang, I missed it with yesterday's move. But look what's happened today. We've come back down. And so if you wait until we come back down towards that 10-day moving average, then perhaps you're like, okay, that's a better entry. But if you did the half-half position, you were happy yesterday and you're like, okay, I'm going to add the other half now. We're back to the 10-day moving average and we are above this A wave high on the zigzag. Another reason why I like having zigzags in these wave threes is that A wave target gives you an added level in addition to the fib retracement levels of support. And if we break that level, then we become a little more concerned. Even though we look for the fail zones which was what the AI give us as far as when maybe it's going to be one of those smaller percentage chances that it doesn't work, that it fails. But we have a lot of data on the AI, and eventually, even a higher percentage than 82 actually hit their targets. I think it's like 88%. But sometimes it takes a while. That's a real challenge when you're trading options because you're dealing with time decay. So you're going to probably see this alert come out, if not today, tomorrow. And we waited on this one. And again, maybe because education is more important than anything else here. There was some comments in the U.S. market update and some from people in the AI impulse strategy and in the new Top Shot as well. And if you're wondering, well, what's Top Shot? If you're not familiar with it, that's a new subscription that we have where I pick what I feel is the best alert each day, or excuse me, each week. Let me be very clear, each week from the three portfolios, the level three portfolios, impulse, time strategy, and volatility. And we send one out each week. And so it doesn't give you as many alerts. It's only one a week, and it's only going to be one trade from the three portfolios rather than the potential of having alerts come out from all the three portfolios. But that's what that is, if you're wondering what it is. And so it's cherry picking, if you will. With CNX, that may come out again this afternoon or tomorrow. And if we do continue with this sideways consolidation today, we may wait till tomorrow just to let some more of that volatility tick out, especially because we had a nice reversal day yesterday. So those are things that I wanted to share with you in the world of the AI is position management, how you manage your own positions. And so those are a couple good examples lately. So I've rambled on. We're about out of time, Zach. So let me go ahead and turn it over to the Q&A. And if you have any questions on any outstanding AI-based alerts, happy to take those now. Otherwise, we'll get back. And for me personally, the VIX isn't really doing much today. That's good. That's a good thing. I would love to see us have a quiet day today and let some of this volatility settle out. Otherwise, we're going to have to go back to doing spreads if volatility ticks up again, and prefer to do straight options if we can, but they don't work as well unless the volatility is a little calmer. So with that, Zach, I'll go ahead and open it up for any questions folks may have.
Alrighty, yeah, I got a few for you. A couple symbols from Jay. First one is APLD.
We looked at this one lately, or haven't looked at this one lately, I should say. But you can see where we looked at it in the past, and I get criticism for not drawing these straight lines. And yes, I know that you can go over and use the line that just draws it straight across. But I don't like to see it go all the way across. It's just my own weird thing. So here's one with Applied Digital where we got too far, too fast, too vertical. Y'all should know this by now. I've gotten some recent testimonials where people are saying that just the 10-day moving average rule, and this goes back years. We've had people that were subscribers for years and years that have gone on and they're doing their own trading, some because they were forced to because they moved to foreign countries. And they said that one rule has changed their trading, just following that. And that's my hope. That's why I'm doing this, is to share a few little nuggets with you that can help you in your own trading. But you go too vertical too fast, you get too far from the 10-day moving average. It isn't going to continue. It can go for a little ways, but it isn't going to go for long. And then you're going to come back down, and you're going to come back down to the 10-day moving average when there's too much separation. And if it's a vertical move up that creates a separation from the 10-day moving average, it's likely going to be a vertical move back down. So Applied Digital, perfect example. And now we have to wonder, because we did break the support level, and that's concerning, because you can see those were the highs back in November, December, tested it again in February. We broke above it, but this is what you don't want to see. How many times have you heard me say you don't want to break a resistance level in a vertical fashion because it tends not to hold? Perfect example right here. You want to see it consolidate under this resistance and then break, not go vertical and break, because this is what happens. So, well, if you're long this, I'd be concerned because we're below the 10-day moving average, and we hit the 10-day moving average on the high, but we're having a quiet day. You have to respect the fact that we may come down to this 50-day moving average. But the five-wave pattern is labeled. The wave four is confirmed. We're at just past the 61.8% level, but staying above 70. And if we can consolidate and hold here right at the $10 level, maybe we can gain some support from the institutions that don't want to risk having to take their position off, and they come in and support it. But if you're looking for a long position, you got to wait till we get back above this resistance line. And I'll give you the exact price there. That resistance line is at 11. So you want it, if you're looking to enter this, back above 11. If you're long the position, you probably have to be willing to endure a little more pain, potentially down to the 50-day moving average. It doesn't have to do that, but that is possible at this point in time. That's where we are with Applied Digital.
Very well. Let's follow it up with MO.
Yeah, that one has Maria has been asking about that one a lot. It was concerning based on some news that they had, but it's doing rather well. It's taking time, but it's had some nice days. Not having one today. We'd like to get it back above the 10-day moving average, but you can see how important support resistance is. It's really struggling with 60. But as long as it holds above the 50-day moving average, and if we can get back above 60 with follow through, I think we hit the AI target relatively quickly. It's a pretty high score, and there's nothing here that's negative. It's just not super positive, if that makes any sense to you. As long as we hold this 50-day moving average and bounce back up, if we get back above 60 again, I think that's the signal that we're off and running. It keeps testing it, but note from old school technical analysis and going back to rules from the volatility portfolio, we are getting a nice set of higher lows, provided that this is the low right now, that we bounce back up tomorrow. So if we're testing the 50-day moving average today, like to see it bounce back up. What we really want to see is a bust above this 60 level. So it's taking its time. So here's an example of one that is taking a while. And this kind of goes back to the rules that I was or the thoughts that I was giving you in the beginning. You can see there was a pretty big room here for it to run on this one. And with that, it got turned back, and this was on some negative news. But the AI has more than just news factored in. It doesn't really factor in news reports, but with over 300 data points supporting the signal, you trust it. And it came back down, and it actually did hit the fail zone, but we closed right at it. We didn't really break below it. A break down to 55 would have been a different story. So we watch this, and then we're looking for a break above 60 for the potential move up to hit the target. So the technical action, there's nothing negative here. It's just frustrating. There's frustration here, but nothing negative. And if we can break above that, then perhaps we get our big run. We've seen that numerous times in the past. So thanks for bringing that one up. I was actually going to talk about that tomorrow night.
Absolutely. And you mentioned Maria. She's got a couple symbols for you. First one's going to be INTC.
Yeah, Intel. Man, I really wanted to see some follow through today, and we would have been profitable. We got right to the point with yesterday's move, but you can see we had a little separation from the 10-day moving average on the close, and we're also right at resistance here. Another one, just very similar to what we just talked about with Mo, a nice ascending triangle pattern. So the lows are getting higher, and Intel has been lagging. I think it's too good of a company to assume that it's going to be lagging for too long. I could be wrong. Maybe they're completely missing the boat. I've often used Blockbuster and MySpace of examples of leaders in their perspective areas that had no vision moving forward and then got blown away by new companies that came out, Netflix and Facebook. And so you don't rest on your laurels in this day and age. Things change too fast. But looking at Intel, what we want to do is give it a chance to break above this 22 and a half level. The call is in the money though, so we have to be real careful here with the 22 strike. Um, with running out of time in the position, that does mean that the delta and gamma go higher. So it will be great if we could break above 22 and a half. But we're going to watch this really closely over the next couple of trading days as we move in towards the end of the week. But having a little bit of a quiet day today is not uh, unexpected. In fact, as I just mentioned, it's better, although, with our position, we probably could have taken it off with a break above it, not worrying about the fact that you don't want to break above resistance when you're already a little bit overbought. But perhaps it gives us an even bigger move to the upside if we can consolidate right here and then break above that ceiling that exists at 22 and a half. What's the next one, Zach? Gonna go quickly here.
Next one's going to be SMCI.
Oh, one of my favorite stocks. And I say that because I feel like they just got brutally beaten up, part of their own accord, because they had some questionable accounting stuff going on, but they seem to have gotten that straightened out. And they are a major player in the AI space. I think it's a little bit of a forgotten stock, and it's one that's really, really interesting to me, and might show up in the speculative portfolio because we're getting this nice move here of higher lows. We've held really well in this support around the 42 level, and we have no more resistance until we hit 50. It's having a decent day today on a quiet day, and you can see the action along this 10-day moving average and tapped it on the low, and we're at basically the only point of resistance that there is here at 45 to move up to 50. So I really like this one, Maria, and you may see that one in the speculative portfolio because it doesn't follow any of the other rules other than you just look at it and realizing that they make a lot of money and they're a big player in AI, and they seem to have gotten their accounting issues straightened out, and the stock got crushed from where it was. So there's a lot of room for this one to move. I think at some point in time, money moves back into this one. I went a little too far there, but moving to, not that long ago at 110, and then to see it down here at 40, 42, 45 area is amazing. So I think we're going to see a little bit more. This vertical break here when it got added to the S&P, and then all the accounting stuff came out and it tanked. following the split. And that was really poor timing for anyone that actually owned the stock. That was horrible to go through a split and then the stock get crushed because you've got all those extra shares that are going down. But anyway, let me stop chatting here. 3 more minutes, Zach. So let's rapid fire if there's more.
Yeah, I was gonna say, I know, excuse me, I know you have a hard stop coming up, and then we still have several questions, so I'll pass through the ones with the time remaining. And for any of those that we don't get to, please feel encouraged to send them to support, and I will escalate them to Rob. Question from Chris. I have a basic question. My broker states this. Please note that the option assignment can occur even if the option is out of the money at or prior to expiration. Are they referring to the case in which it goes out from out of the money to in the money due to aftermarket trading? If so, how long do they have? I thought out of the money in the money was at market close.
No, your broker is correct, and I don't say that very often because there's a lot of people on option desks and brokers that don't know what they're doing. But anytime you have a short option, whether or not it's covered in a spread, like a calendar spread or a debit spread or a credit spread, but anytime even you have a long option covering it, a short option can be assigned at any time. It shouldn't be assigned, and that's a key word. Shouldn't be assigned until expiration if the option is in the money. But it can be assigned anytime. And if it's assigned early, the other person on the other side of that created the assignment doesn't know what they're doing because they forfeited extrinsic value by doing that. Doesn't make us feel any better. But as I was just chatting with a subscriber that experienced assignment for the first time on the OKTA, and it turned out to be a 30% gain for them because we get assigned and then OKTA jumps up on Friday morning. Worked out great. And we love that. So assignment normally, and Jeff and I have tried to hammer this point home as much as possible, albeit scary because of the way the brokers react. Oftentimes, more often than not, and that's not a cliche, that is true, is a positive thing. 100% guarantee on assignment is that it gives you flexibility. So it doesn't guarantee, not saying it guarantees a gain, but it gives you choices. You have opportunities. You have flexibility with assignment. But oftentimes it's a good thing. But just to further your question, your broker's correct. Anytime you have a short option, it can be assigned at any time. It's an automatic assignment if it's in the money by 25 cents at expiration. So if it's in the money by 25 cents or less, it's an automatic exercise on expiration. But that's the rule. But there are random assignments periodically. But who was it that asked the question?
That was Chris.
Chris, just know that if you get assigned early, I don't want that to be a concern to you. If you get assigned early, that's a wonderful thing because if they assigned you too early, they gave you the extrinsic value, and then you have a choice to make. All assignment means is that you need to take some sort of action. And for those of our subscribers that have a large accounts, they've chosen just to hold the shares and wait because they hold shares with a long protective put. That's known as a protective put strategy. And they are willing to wait for the shares to move higher. It gives you a net positive delta because you have a positive 100 delta on the stock and whatever the negative delta is, probably around 50 on the put. So you have a positive net 50 delta, which means if the stock moves higher, even with your protective put, you're still making money. And then they handed you the extrinsic value, which gives you a little bit of a jump start on a potential gain in the trade. So I love it when somebody assigns me early, but it does tell you that whoever was on the other side doesn't know what they're doing because they wasted money. It was a dumb move on their part, but it does happen. And I know for our newer subscribers that haven't had a whole lot of experience with assignment, and if you happen to watch the insiders meeting, we've had a lot of subscribers that have come on and they've talked about how when they had their first assignments, it scared the heck out of them, and now they don't worry about it at all, and they actually kind of like it. when it happens. But I know it's a scary thing. This is the same conversation that I had with another subscriber. I won't mention their name, but um, yeah, when you first go through it, it scares the heck out of you. But it just means you need to do something. Or maybe you don't. If you want to hold the shares, if you want to hold the shares and you have the buying power in your account to do it, you don't have to do a thing. But if you don't have the buying power and they're threatening you with Reg T calls and all this crazy negative crap that the brokers send out, it's scary and it scares you. Don't let the fact that you can get assigned early scare you. It can happen. It's very rare, but it can happen. Um, Anytime you have a short option, you can be assigned at any time. But if they assign you early, one of the things that you might want to do, a great consideration is say, okay, sell the shares once you're assigned and reset up your position. In other words, keep the long put and then sell a new put. And if they assign you again, do it again. We are going to have a show at some point in time about how Warren Buffett trades, and that's how he trades. It's exactly how he trades. So it's a good thing. And I guarantee you, when somebody assigns, well, I guess Warren Buffett's stepping away now, but anytime they assign him, he's laughing all the way to the bank.
Absolutely. Looking forward to that session. If you got time for one or two more, I know you got a hard stop. And as I said, for any questions we don't get to, please feel encouraged to submit them to support, and I will get them to Rob, who can reply via email as soon as
Yeah,
possible.
or ask tomorrow night. We'll try to do an extended Q&A tomorrow if there's that many questions. You don't usually get this many questions on Hub Live, so this is great. This is awesome. So yeah, let's do a couple more here, and then we'll have to wrap things up.
Very well. Question from Alexander. What percentage of the price do you consider too far away from the 10-day moving average?
It changed it, that's a question that's come up before, and it's a really, really good question. And I wish there was a hard, fast answer, but there's not. It's different from every stock. Every stock has a different amount that is considered separation from the 10-day moving average. You kind of have to go back and look, and you'll see it. Just like looking at SMCI is a tough one because the scaling is off because it's was so high and now it's so low. But you can see here we had this big drop and we got down here right back to the 10-day moving average. We got overbought, back down to it. Little bit oversold, back to it. Way overbought, back to it. There is no rhyme or reason. There's no definitive answer. It's you kind of have to feel it like, and that's Pankaj had come on several weeks ago on the insiders meeting saying you kind of have a unique way of figuring out when things are about to turn. And he oftentimes wants to let it run a little further and then it reverses. It's just feel. And if you start to feel like, oh, maybe I should start taking this gain that looks a little too far from the 10-day moving average, then it's probably a good time to go ahead and take it. I'm sorry that isn't a more definitive answer. I can't give you an exact percentage away from the 10-day moving average because every stock's different, and that's where the issue lies.
Very well. Question from Jared. What do you mean by support? Do you mean the institutions will buy more of the stock to increase the price?
Yeah, it's on the 10-day level, what I was referring to with support there. Institutions come in and support it. And if you haven't heard this before, I try to say it as often as possible. But the way the rules work in the regulatory area is any investment company, and mainly mutual funds, et cetera, that have growth in their investment objective, whether it's a growth mutual fund, whether it's growth and income. What is their investment objective? If growth is in there, then they're allowed to own stocks at $10 or higher. They're not allowed to own stocks below $10 unless aggressive growth is their investment objective. That allows them to own stocks above $5. So if a stock is trading below $5 and it moves up above $5, and you see a big run, that's because some institutions with aggressive growth as their investment objective have stepped in and bought. But there's a much bigger marketplace, if you will, of investment companies that have growth and income as their investment objective. And that gives more buying power, more potential liquidity to the issue. Now, if a stock is above $10 and institutions own it, and then it breaks below $10, there is a time frame and it keeps changing. So I don't know what it is right now, but there's an amount of time that the regulators will allow them to still own the stock below $10 before they're forced to sell. In other words, if you're an investment company and growth is your investment objective and you had a stock at $12 and now it's at 8, so it's broken below that $10 threshold, then you have a limited amount of time where if the stock doesn't get back above $10, they're going to make you sell. And then that means that you're going to realize the loss as an investment company, right? Because losses aren't realized till we actually sell and take the loss. So at that point in time, uh, they have to take the loss. They don't want to do that. They'd rather come in if they like the company and they feel like this is just a technical thing, then they'll come in and buy more. They want to force the shorts out. And, you know, this is the whole thing going back to the meme trading where the retail traders had this crazy idea that they could do it. They're not powerful enough. They need institutional support to do it. But if the institutions come in and buy, it'll force the other shorts out, and then they can get a run back above $10, and then they're safe. And then that buys them some time for hopefully their viewpoint is that the stock is going to go a lot higher than 10 into the future. That's why they bought it in the first place. So that's what I mean by the $10 support level. So I've talked about that before. Hopefully that's a good recap of it for those of you that may not have heard that before, but those are regulatory rules. That's how it works.
Very well. And still lots of outstanding questions. So if we want to call it here, and again,
Give
I'll
me two
emphasize.
more. Give me two more, and then we'll go.
Okay, very well. Question from Sean on CELH.
Good old Celsius. We got asked about that a lot, and this is what you want. Thanks, Sean, for asking about this because this is what I'm talking about. We ran up to the wave three, we had the wave four, we came up, we tested it, we came back down. Nice consolidation right underneath that wave three high, and then we broke it, and look what happened. You know, just minor corrections on this impulsive move to the upside. The problem now is that we're at the wave five now. We're in the tap box, and we've had an 86% extension on a 38.2% B wave or wave four correction. So we need to be careful here on Celsius now. What we need for this to continue higher is for this pattern to relabel and that five to turn into a three. So I'd be very cautious of this right now at this point in time.
Question from David, and is INSM in the category of too high, too fast?
It was, and unfortunately, this one hasn't retraced as much as I thought. We may have to take this one off as a loser. You can see that the AI score had given us 16%, so it was a very low chance of it continuing higher from here, but it has in fact done that. It didn't really correct yet. So it is the definition of too high, too fast, and maybe we just need to be a little more patient and wait. There's separation from the 10-day moving average. I still fully believe that it will correct at some point in time, but man, this is why I hate these stocks. You get into the pharmaceuticals, the medical industry, anything along those lines, they just act crazy. And all we did was consolidate sideways this move and have continued higher. But when you look at the DMI, that ADX is really high. The positive directional indicator is moving below the ADX. You don't often see an ADX go that vertical. So that's showing too far, too fast. And then look at the CCI, the one that's more accredited to day-to-day movements. And look at this. Obviously, a very extreme point high here if you're familiar with the CCI. And if you're not, then you need to go look at the information on our confirming indicators in the education area on the Evo Trader site. This is massive divergence here. The CCI is moving down, is broken below positive 100, which means it should come down to the 0 point, and yet the stock is going up. So we have major divergence here. with the stock going higher and the CCI saying that it's running out of short-term steam. So perhaps we get that corrective move that we've been waiting for and have at this point in time not gotten just yet. But the indicators are telling us that it's coming. So that's what we're trusting. All right, with that, Zach, I'm going to have to run. And thanks, everybody. Sorry if I didn't get to your question. Hopefully, you'll re-ask some more tomorrow night during Insiders. Let's see if we can stay calm throughout the rest of the day. You can see what's going on intraday. We had a move down. It was immediately retraced. Let's root for that through the rest of the day. Let's just have a quiet day today. And I think that is very constructive for the market. So thanks for your attention during the live trading day. And I'll talk to you during Insiders tomorrow night. So have a great afternoon, everybody. Take care.